This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Big elections in Mexico and India. In Europe, the ECB cuts rates. And in the U.S., all eyes are on the jobs numbers. This is Bloomberg Wall Street Week. I'm David Westin. This week, Ralph Schlosstein of Evercore on getting deals back on track.
We're actually in a period of returning activity.
Raghuram Rajan of the Booth School on what the Indian election means for investors.
Hopefully, a more democratic India, which is what this election means, will actually enthuse some of them.
And Ford CEO Jim Farley on the return of Detroit and the U.S. auto industry.
We're in a different era where Detroit is growing after decades.
We begin with the markets and their reaction to those U.S. jobs numbers out on Friday. Once again, the labor market surprised to the upside, adding another 272,000 jobs, with earnings increasing 0.4%, both well above what was expected. And at the same time, the unemployment rate paradoxically ticked up to 4%. The bond market reacted with a vengeance as the yield shot up 14 basis points to 4.43% at the end of the week. That until Friday was all about falling yields. The stock market, though, once again seemed to take it pretty much in stride. For the week, the S&P 500 was up 1.3% to close at 5347. That is nicely above that median number our Bloomberg elves have for the year end of 5200. And the NASDAQ, it was up 2.4% for the week. To take us through all this now, we welcome Sarah Ketterer of Causeway Capital. So Sarah, thank you so much for being back with us. Really appreciate it. So explain exactly what the market reaction was this week, because the stock market really didn't react too vigorously, although the bond market did to these jobs numbers.
Well, thanks, David. The stock market is likely taking its cue from earnings more than it is any of these potential underlying impetus for changes in interest rates. Likely most investors recognize that the Fed is in a difficult position and lowering rates might be tough with this sort of strong data. On the other hand, earnings coming out of some of the market leaders still looks really good. And that's probably what's keeping the market afloat.
So I wonder about this question of interest rates. There's a lot of speculation about what's going to happen this year for the Fed. We went into the year with six rate cuts baked in. We're way off of that now at this point. But what about for the longer term? Are we getting a sense maybe the longer term interest rates, some people call the neutral rate, will be higher? And if so, what does that mean for you as an equity investor?
Well, if you care about valuation, you have to use tools like discount rates. In other words, a stock is just worth the present value of all the cash it can generate into perpetuity, discounted to present. And as the higher that discount rate goes, the less the cash flow stream is worth. Or think of it another way, the valuation multiples need to come down. So prolonged higher rates is a kind of a sobering effect for markets and investors. We have to be very careful about what we pay. And it also makes fixed income a very viable alternative to equities. So there's competition out there. So higher rates, if they're sustained, also have economic impacts that we have to take into account when we do valuation work. So there are all myriad of reasons why sustained higher rates can lead to a tougher environment for stocks, not just because companies' earnings may be under pressure, but also because investors might want to go elsewhere. Over any reasonable period of time, the stock market has done pretty well. Take the S&P 500, for example. But there are a few stocks that have really driven it disproportionately. Some of those big tech stocks, the AI stocks. Can that keep going? They could. It's very hard to call the tops of any of these stocks that have so much momentum behind them and have sold their product, like NVIDIA, far out into the future. They look so certain. And yet, as the price rises, it gets closer to something that approximates fair value. And we're not seeing the big earnings upgrades any longer. The pace of that has slowed. So it's very likely that these big market leaders, at least for the time being, the next 12 months, have seen the bulk of their returns. Now the question is, what's the next set of stocks that will benefit from the same theme that propelled these big market leaders? And if it's not GPU, if it's not the chips and it's not the servers or the data centers, then what? And there are some fascinating, great stocks in that layer beneath who should benefit from, for example, the demand for much more memory. So that's DRAM memory, not just the high bandwidth memory that an SK Micron has and Samsung Electronics soon will have, and Micron in the US, but even the commodity memory will be more in demand because there's only so much factory floor space. There's almost only so much room to make these high bandwidth memory chips. They're faster. They're less power consumptive. So memory is so interesting, and stocks like Samsung trade at very reasonable multiples.
What about some of the stocks that have actually taken something of a hit, particularly in the information tech services area, on the assumption that perhaps generative AI will really hurt their business? Is it possible the market's overreacted with some of those?
Those stocks had a terrible time when cloud was first transitioning because enterprises say, we can do it ourselves, and they very much can't. First of all, for most companies, they need to build the infrastructure to adopt AI tools. So infrastructure comes first and then applications second. And you can look across almost all IT services companies and find that the market is very negative on them, but they have good base businesses, and without doubt, and since companies like Cognizant, for example, in the U.S. or Fujitsu in Japan, the orders will have to pick up because enterprises were going to need help. Enterprises will have to work with their IT services companies in ways they've never done before in order to implement AI.
Sarah, it's always such a pleasure to have you with us. Thank you so much. That is Sarah Ketterer of Causeway Capital. Higher rates and greater uncertainty have put a damper on corporate deals, coming off of what had been record years. To fill us in on where things stand today, we welcome back now Ralph Schlosstein, Evercore Chairman Emeritus. So Ralph, great to have you back with us. Where are we right now in deal flow?
Well, we're actually in a period of returning activity. So if you look particularly in the U.S., announced transactions in the first 5 months of the year are about 40% of last year. The last 2 years have been a period of low activity, driven predominantly by uncertainty rather than economic uncertainty, because that is the enemy of M&A activity. And if you look back over the last 45 years, go back to 1980, M&A has generally been characterized by 5 to 8 year up cycles and 2 to 3 year down cycles. And we're kind of at the end of that 2 to 3 year down cycle and at the beginning of what I suspect will be an extended period of increased activity, 24 being better than 23 and 25 being better than 24.
So as you know, here at Bloomberg, we pay a lot of attention to the Fed. Are they going to cut? Are they not going to cut? Are they going to raise? What's going to happen? At the beginning of the year, there was something like 6 rate cuts priced in. Now we're down to maybe 1. Does that affect CEOs thinking about doing deals?
It really doesn't. What they care more about is the availability of debt capital rather than the cost. And I think we're at a period right now where the cost of debt capital, the risks are asymmetric. The risk that it goes up is lower than the risk that it stays where it is or drifts down. So that's kind of off the table today in terms of transaction activity. Economic uncertainty and political uncertainty now are not unimportant in having people think hard about whether they do transactions.
If you talk to private credit people, as I know you do all the time, they say, yes, we're lending a lot of money, but we're much more careful about it. We put a lot more restrictions and covenants and things like that on it. Is that true in your experience?
No. To be honest, I think credit, there's this thing called the credit cycle that we've heard about for many years. Credit, there are periods of time, like right now, where people feel some amount of pressure to put assets on the books, whether they're private credit or banking. And that tends to weaken a little bit the underwriting discipline, not thrown away, because I think we all learned from 2008 that discipline in credit is really, really important. But I recall once when I was at BlackRock, we were hired by Xerox to make a decision about what they should do with their insurance business. And one of the things we did is we visited 5 of the smarter people in the property and casualty business, one of whom was Warren Buffett. So we flew out to Omaha and we met with him, and he talked about the property and casualty business. He said, I've bought every single one of my underwriters a golf club membership. And the only thing that I do is I tell them when they must use their golf club membership and when they can't. And his point was, there are some times when the underwriting cycle is really bad and I want you all to play golf, and there are times when it's really attractive and that's when I want you to not play golf and write lots of policies. And, bankers and private credit don't have that same luxury. Discipline, not in major ways, but in minor ways, ebbs and flows. And pricing, the tightening of spreads. So we've had a period where longer-term interest rates have risen. That has been largely offset by a tightening of spreads versus the Treasury market. So a double B borrower today can borrow more cheaply than they could a year ago, notwithstanding the fact that Treasury rates are up 80, 90 basis points.
Cycles in M&A. Are there also trends? Because most recently, some of the deals we've seen have not been conglomerations, really bringing together bigger companies, but actually focus, spinning off. You look at GE, you look at DuPont. Is that a trend right now in M&A? Are people more interested in focusing?
I would say, over 40, 50 years, you've seen a period of time when conglomerates were overvalued relative to the sum of their parts, and a period when they're undervalued. We're in one of those periods where in companies that are in multiple disconnected business lines, the value of the whole company is generally less than the value of its constituent parts.
Ralph Schlosstein is going to be staying with us as we turn from the business climate for mergers and acquisitions to the political climate. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Evercore Chairman Emeritus Ralph Schlosstein has stayed with us. So, Ralph, you were good enough to tell us about the business climate for M&A. Let's talk about the political climate, where we are right now, particularly as we're looking toward an election come November. What are the things that might affect, actually, the level of deals that get done?
Well, first of all, you have to recognize that antitrust is driven predominantly by the law. The law has not changed. There are people at the FTC and obviously the Assistant Attorney General for Antitrust who may have a more aggressive or less aggressive posture within the confines of the law, and sometimes not within the confines of the law. So there's no question that the Biden administration has tried to reasonably aggressively slow down activity. Almost any transaction of consequence, there's a discussion of that. And what you're finding increasingly, where there's a judgment that the antitrust law is not being violated, companies are willing to go ahead and basically say, let them take me to court.
So you worked for President Carter, as I recall, in the Carter White House, and you've been identified with Democratic causes through the years. At the same time, you're very much a part of Wall Street. There's sort of a prevailing sense right now, among some of Wall Street right now, that it just makes sense for them, personally, to have Trump in the White House because they'll make more money. They'll be richer. Is that wrong?
Well, it's interesting. I once got asked what was the very best piece of advice I received in my entire 45-year professional career, and it was actually the first day of my very first job when I was an economist on the Joint Economic Committee, and the staff director had this sort of welcome talk that he gave to kids right out of graduate school, and the gist of it was listen to people. This was a joint committee, bipartisan committee. You're going to have disagreements on substance, but never question someone's motives. So I do believe, certainly, that there are some people in the Wall Street community, the financial community, who probably are driven to a certain extent by what's best for their pocketbooks. But I'm also, I think, open-minded enough to say that there are certainly some of them who may support President Trump who do so because they have, particular policy agreements with him or disagreements with the current administration. So I don't think it's purely financial. I happen to be, as you say, very democratically inclined, but in this election, honestly, I think the stakes on policy are really important, but the stakes on support of our democratic institutions are even more important. And the idea that our judiciary deserves to be truly independent, the idea that our Federal Reserve should be truly independent, the idea that our Justice Department should be free to investigate independently, the idea that our press should feel unencumbered by fear of reprisal if they report, unhappily on the current administration. Those are things to me that are so important that, to me, that's a really critical part of this election.
I didn't mean to suggest it's wrong to be considered a pocketbook, because it's generally thought in most elections, most voters in part are voting their pocketbook. It's perfectly understandable.
Yep.
But when it comes to a Trump administration, one of the differences potentially with the Biden administration is taxes, the extent to which is taxation. And it's closely, I think, related to a concern that some people express that just the Biden administration, for whatever reason, has gotten the government just involved in a lot more of business, and that's not in the long term healthy. What do you make of that?
Well, I think attractiveness of generally Republican policies in terms of a little, somewhere between a little and a lot less regulation. I'm not negative on that, to be very honest. I think the most critical thing for narrowing the economic gap in this country is economic growth. And regulation, sometimes over-regulation, can certainly constrain economic growth. So I think there are elements of what would be considered traditional Republican policy that I think are very supportive of economic growth and helping those who are in need in our society. Tax policy, I think two things are really important. One is the share of our GDP that goes to federal taxes today. It's around 16%. That's down from about 19%. We're not paying for the government that we want, and that's a long-term, non-sustainable situation. So that has to be corrected one way or another. And the second thing is, I think, the tax policy has been significantly responsible for the widening in the wealth gap in this country. I'm one of these very rare people in finance who believes that capital gains and dividends should be taxed like ordinary income rather than at half the rate, because there's no reason on the planet that when I make a private equity investment, the tax rate should be less than somebody who's making a couple $100,000 a year and working 40, 50, 60, 70 hours a week. I'm a minority. I probably even am a minority in my own party in that regard. But look, I think If you look back over centuries and centuries, great societies failed because the haves had too much relative to the have-nots, and that's not a healthy thing for America, in my view.
Okay, Ralph, thank you so very much. It's really great to have you with us. That's Ralph Schlosstein of Evercore. India completed its national elections this week, and to the surprise of many, President Modi did not receive the overwhelming majority that had been expected. For an early sense of what this may mean for the Indian economy and for investors, welcome now Raghuram Rajan. He is the former governor of the Reserve Bank of India. Mr. Rajan is now a professor of finance at Chicago's Booth School. So, Professor, thank you so much for joining us. I know it's early going, but obviously Prime Minister Modi was known for his economic reforms, his economic projects. What do you think is made of those in light of this narrow victory?
Well, first, he doesn't have a majority anymore with his party, so he needs coalition partners, which means he needs to develop more consensus as he goes along. I think that's good news, actually, because part of what was going on with this government was it had a lot of reforms in its first term, but the second term has been more focused on the social agenda of the government, sometimes the majoritarian agenda, while the few attempts at economic reforms, including the change in agricultural laws, were done without developing a broad consensus and essentially were withdrawn after tremendous pushback by the farmers. So this may actually mean that the reforms that are proposed going forward have more consensus and therefore more sticking power.
Do the reforms, in your opinion, are they likely to focus on some of the lower income families? Because the reports, at least of the politics of this election, were that many of the lower income voters did not back Mr. Modi.
Yeah, I think a big problem which the government hadn't paid enough attention to was growing levels of unemployment, especially amongst educated youth, a growing sense of insecurity amongst poorer households. The small and medium enterprises were also suffering. So essentially, the government was looking at the big, capital-intensive enterprises, which comprise much of the stock market. No wonder the stock market took fright after the early election results. It's come back a little bit. But really, the government has to pay more attention to these groups, and it actually may help even enhance growth over the short to medium term, because consumption hasn't been strong as these households feel anxious. A revival in consumption could help the economy grow faster.
One of the things that investors have paid attention to is inflation in India, which certainly still has inflation, but it's more under control than it has been in the past. Is there a risk in trying to address some of the needs from the voters who did not vote for Mr. Modi, that you actually have more fiscal stimulus and you actually have more problems with inflation going forward?
Well, one of the sort of hallmarks of the Modi administration has been fiscal restraint. And I don't see why they should suddenly abandon that. Yes, there needs to be a repurposing of resources. As in a recent book, Breaking the Mold, I argue that, we need more jobs in areas like services. And that requires skilling the workforce. That requires some redeployment of resources away from, for example, massive subsidies to manufacturing, to actually investing in colleges and schools, in skilling programs. But I think this is something that can be done without breaking the budget. Yes, there will be some more fiscal spending given the nature of the verdict, but I think it will help solidify the economy and actually remove household anxiety, which I think would be a big win.
What do you think this election may mean for the relationship between the central government and the individual states? Because as I understand it, in India, the states have a fair amount of power. The Prime Minister can't do certain things without the support of the states. Is that going to shift now because Mr. Modi is perceived as being somewhat less powerful?
It should, but I think in the right direction. One of the problems in the Modi administration has been the appointment of governors who have stood in the way of state governments doing what they wanted to do, and not playing out as constitutional sort of impartial governors. And as a result, I think some of the states have not been able to sort of conduct the kinds of programs that they wanted. I think that should be ameliorated in a new administration where there are checks and balances on the government and where the press is a lot more invigorated in pointing out some of these problems. I think in the last two administrations of the Modi government, the press was cowed, was unwilling to point out problems. I think with the press more alive, I think we'll get stronger debate. And hopefully, debate leads to better economic as well as political policy.
Professor, thank you so very much for being with us. It's terribly helpful. That's Raghuram Rajan of Chicago's Booth School. Coming up, the highs and lows of the U.S. auto industry and the motor city it created. We go to Detroit for the story of the rise and fall and rise again of a proud city and automaker.
The train station felt like the right kind of challenge for Ford to be part of so that we could be part of the revitalization of Detroit.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. This week, the city of Detroit went back to its past on the way to its future with a grand reopening of Michigan Central Station, once a proud icon of the Motor City, then a derelict hulk that was nearly torn down, and now restored to its former grandeur with the help of the Ford Motor Company, and the dedication of a mayor who just wouldn't give up. Our Bloomberg Radio colleague Michael Barr is a native Detroiter who watched the city burn during the riots of the late 60s.
I'm going to give away my age because that happened in 67. And I was 3 years old. And I was in Southwest Detroit. And at the time, I saw the National Guard in a Jeep go by. Now, being a stupid kid, I'm thinking, oh, G.I. Joe. I didn't realize that the daggone city is burning down. It's sad. And between that, how the auto industry really took a hard nosedive.
What was Detroit's lowest point, do you think?
Oh, I think probably bankruptcy in 2013 was rock bottom, but we had a lot of bad years before that. And I've said I'm 65 years old and the city of Detroit has lost population every year I've been alive until last year. So that was a lot of years of auto plants moving out, restaurants moving out, movie theaters moving out, people moving out.
The story of Detroit has long been a story of the auto companies that helped make it, sometimes for better and sometimes for worse.
I think, World War II was a big challenge for the company. And when Henry Ford II led the company back to a revitalized state, we through the whiz kids, we hired all these logistics experts from the Army after the World War II, and they really created this kind of bureaucratic but incredibly efficient machine. And the company was back in the 60s. And then the energy crisis came. The company didn't have efficient vehicles. It wasn't competitive on quality, and it really lost its way in the 70s, as well as the city of Detroit after the riots. And we were lost.
In less than 25 years, Henry Ford personified the American-dualism and freedom of enterprise.
It wasn't always this way. As the 20th century began, Henry Ford started mass-producing a new mode of transportation, the automobile, in Detroit. Ford invented the first moving assembly line in the world, and by the 1920s had produced some 20 million Model Ts.
My grandfather's a good example. He was an educated man, but he had a great job at Ford and built his family. His kids went to, college eventually, and just like your family, there are millions of people around our country, around the world that have been affected by Ford. And at that time, Ford was the pinnacle. We had 80% market share globally of the car business.
The Michigan Central Railway Station was a result of that automotive success. Built in 1913, when the mythic Ford Rouge plant was still under construction. At its peak, over 200 passenger trains a day left the station carrying over 4,000 passengers. And another 3,000 people worked in the office tower above the station.
But again, I see Detroit through the eyes of a kid who remembers a beautiful city. I remembered a beautiful train station.
But in the end, the auto industry that helped build Michigan Central was also a central cause of its fall. As people moved away from passenger trains and took to the cars Detroit was churning out for the entire country. By the 1980s, it was the domestic auto industry's turn, as U.S. sales of the big three automakers peaked in 1979 and then declined steadily ever since, falling victim to a rising tide of foreign cars. And with it, the entire state of Michigan's contribution to national GDP fell from over 4% to less than 2.4%.
It was heartbreaking over the years to see Dodge Maine close, to see Cadillac Fleetwood close, and the jobs went with them, and they went to the suburbs, and eventually they went to Mexico.
By the start of this century, what was once a glorious building had been abandoned. Its windows broken, its roof open to the sky, its marble scavenged.
With the windows gone, the air blowing through, it was depressing every single time you came into town on the freeway.
By 2013, the Detroit City Council had voted to tear Michigan Central down. And it took a Detroit backed by Dan Gilbert's real estate investments, a determined mayor, Duggan, and a Bill Ford, whose family had helped build Detroit, to reclaim it and restore Michigan Central to what, as of this week, it is again.
So, from my first day in office, getting that train station reoccupied was a central focus. There was no way it was going to be demolished. It just meant too much to too many generations. And so my first month, Matt Maroon, the owner, was in my office, had a list of things that they wanted, and I said, I want one thing. I want you to put windows in that abandoned train station. And he looked at me like I was crazy. And I said, all people see when they look at that train station is blight. I remember when it was beautiful. And so we made a deal on some other things where they spent $1 million to put in windows. And when the windows started to go in, it had an electric effect in the city. Everybody driving by on the freeway said, oh my God.
For Michigan Central and for Detroit to come back, Ford and the rest of the auto industry had to come back as well, once again showing their mutual dependence, which is why Ford stepped up with nearly $1 billion to rebuild a train station from 1913 that hadn't been used in nearly 40 years.
I think it's, obviously it's a family company, Bill's vision, but also for the train station is very much a symbol, a kind of a mark along our journey to create a great company. And we avoided bankruptcy, which was amazing in the early 2000s, mid-2000s. But to build a vibrant company, in the EV world, the digital vehicle world, the train station felt like the right kind of challenger project for Ford to be part of, so that we could be part of the, revitalization of Detroit, which had really been kind of used by almost the national media as a, example of the decay of the country. And this felt like the kind of project that would be emblematic of our recovery as a company. Yeah, it's a very American story, really, of starts and stops, of great leadership at moments, but at other moments, a loss of focus on the customer. I mean, this is the truism of an industrial company. You have to have cost and quality competitiveness, and that changes. The benchmark changes at many points of the. We almost went bankrupt with the Model T. If you look at the company, this has happened many, many times. It's a company that's been through a lot, but it's a company, though, that when it gets its back against the wall, something magical happens.
Where are you on the road back? How far along that road are you?
Our backs are off the stovepipes. We're well into the messy middle of the most transformational time other than the Model T. We've never gone through this electrification transition for low CO2 drivetrains. We've never had a digital product before. We never could give people time back like we will with level 3 autonomy. We're investing in all that enabling technology. We're very profitable with our Pro business and our combustion business. We have the iconic vehicles like Bronco and Mustang that are doing, and F-150 that are doing so well. But we still have a lot of execution to do. I'd say, we're just a few years away from another vibrant period for the company. And as leaders, we see it before everyone else sees it. And so it's exciting for us, but we feel a tremendous amount of responsibility for your parents, for you, for my grandparents.
As Ford and the other Detroit automakers have fought their way back, they've brought jobs with them. Michigan unemployment peaked, apart from the pandemic, in 1983 at 16.5%, well above the national average. And now it's all the way down to 3.9%, right at that national average.
But when I started, I sat with Bill Ford, I sat with Mary Barr, and I sat then with Sergio Marchionne, who was running Fiat Chrysler, and I said, look, if Detroit's going to come back, we've got to come back on our strength. We're not going to be the tech hub, the biomedical hub. The next time you cite a parts plant, please ask them to come talk to me first.
William Faulkner famously wrote that the past is never dead, it's not even past. This week we had our fair share of reminders of the past remaining very much with us. In Detroit, the iconic Michigan Central Station came back from the near dead and emerged as a gleaming new home for Google and high-tech mobility.
This is going to be an innovation hub with software engineers and our Ford Pro business and many non-Ford people in the building.
Meme stocks like GameStop, which seem oh so 2021, came roaring back to life, with Keith Gill posting on social media what appeared to be a $116 million position in the stock, together with a green reverse Uno card, which seems a bit retro in and of itself.
The only people that I really dislike and loathe in this entire situation are the people who pretend that buying GameStop or buying AMC is some sort of like revolutionary act, or like sticking it to the man, or like doing it. It makes no sense. There's no there.
And speaking of social media, this week former President Trump returned to the question of TikTok, but came up with a very different answer this time. When he was president, he wanted to ban it. Now that he's on a quest to attract young voters, he's decided he'd rather join it.
The president is now on TikTok. It's my honor.
And when it comes to politics, what could be more nostalgic than a rematch of Trump and Biden? Something we saw most recently only 4 years ago.
I have never tried to forecast the outcome of an election where you had the current incumbent running against a former incumbent.
In big media this week, we saw two very different examples of the past not ever fully going away, as Rupert Murdoch got married for the 5th time at the mature age of 93 to a woman 26 years his junior. But Mr. Murdoch's marriage may have been eclipsed by a bigger union in the media world as Paramount moved toward merging with David Ellison's Skydance studio, something that's been in the works for a while now, and that is very much driven by the media revolution of streaming, which is yet another example of the past never being entirely behind us. We've had periodic upsets in the media world that almost always bring corporate shakeups. When I went to Cap Cities ABC in 1991, broadcast television was in the process of being turned upside down by what we used to call basic cable, a new way to get better reception of network reruns that turned into a powerhouse of original programming tailor-made for particular audiences, everything from drama to sports to news to cooking. And as much as we talked about it, too many of us at the network told ourselves that this upstart cable could never challenge the strength of the networks. But it's safe to say that was a simpler and occasionally more ridiculous time.
The decision has been passed down to make Veronica our co-anchor. No!
Let's hope that as big media makes the big transition this time, we can leave some of the past truly behind us. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.